Paul Cavey, thanks very much indeed for joining us.
Give the government some confidence, think about the economy more broadly going well for China. The more interesting story is you look at TSMC.
Hello everyone, I'm Paul Cavey from East Asia Econ. We're a specialist firm looking at the economies of China, Japan, Taiwan and Korea. So I'm here today to talk about what's happening in Japan. Now obviously Japan's in the headlines, particularly at the moment, because of this new red letter day from Trump over the course of the last couple of days. And this renewed threat to increase tariffs from August the 1st. And in fact, Japan is in that special position of being one of the few economies where Trump has actually threatened to raise tariffs even more than was initially posed on April the 2nd on the so-called Liberation Day. How will tariffs impact Japan's economy? And in particular, what does it mean for the yen? And what does it mean for the Bank of Japan? Because we are in this situation where at least 6 months ago, and perhaps even 3 months ago, it was very easy to argue that the BOJ was finally in this position where it can continue to raise rates, not just to the 0.5%, which is where they stand today, which is the highest they've been over the course of the last 30 years or so, but finally to break through that 0.5% and continue to hike, in fact, perhaps even beyond 1%. So really like a fundamental change in a lot of the things that drive markets, policy and the economy in Japan. We were really on that cusp. Since that happened, the BOJ has slashed its forecast of GDP growth in Japan over the course of the next couple of years and has suddenly become a lot more pessimistic, or at least has a very much wait-and-see attitude into what happens next. So it really seems like tariffs are this sort of fundamental, important issue for Japan's economy. There has been a very important change in the way that the banks interact with the economy. And the clearest way of showing that is from the BOJ's Tankan survey. So this is a quarterly survey which the Bank of Japan does of a large number of companies across Japan. One of the questions they ask in that is about the availability of getting credit. Are banks willing to lend to you? That's essentially what the question is asking. And what you can see from that is there's a very clear recovery in the ability of companies to get finance from the banks. And because of that, what does that say? That says that there's very clearly an improvement in the financial position of the banking sector, that the economic problems of the 1990s and 2000s, which are self-reinforcing, where companies find it difficult to repay loans, banks don't have debt, banks then don't have credit which they can lend out to new companies, which slows the economy even more. That sort of self-reinforcing cycle has now begun to fade. The banking sector is on a surer footing. They're more willing to issue credit. That means that the economy as a whole is on a much surer footing. So that's the first thing I think to understand in some of the changes that happened since the 1990s. So that's one thing, the banking sector. The second thing that's happened since then is big changes in the labour market. And so if you go back and look at where Japan was in 1989, a lot of workers were in full-time, regular employees working in big companies, right? This kind of salaryman reputation that Japan had, and lifetime employment, right? Like people assumed that they go into a good company and they work in that company for the rest of their lives, and they would have benefits to the crew with that position. So these were good jobs to have, they paid well, and they were what every graduate wanted to get. The problem from a corporate point of view was this structure of the labor force was very expensive, right? Like you're paying these people like throughout their lives, and every year they stay in the company, their salaries automatically go up because of seniority. It's very difficult to fire these workers. It's very difficult to lay them off. There's no flexibility in the labor market. There's all of these sort of problems. And so as the corporate sector in the 1990s began to have a lot of financial difficulties, this became very expensive and very difficult to sustain. Now, in Japan, as the Bank of Japan has noted and other economists would have talked about, that there's also a strong preference for keeping employment, for preserving employment and therefore sort of social stability, right? Like it's sort of like a cultural way, a cultural facet of Japan's economy. What does that mean? So how do you get around that when you have this kind of full-time employment and you're a company which has financial difficulties and therefore is finding it difficult to sustain that kind of employment? The fix was to hire a lot of irregular workers, right? And in that process, unemployment slowly began to increase in Japan. So companies were trying to reduce their wage bill essentially by making their labor force more flexible without laying off the existing workers that they already had. Now, because there wasn't that sharp layoff of workers, that's a process that takes many years to play out. But what, again, you can see happening, a bit like the banking sector, is over the course of time, there were clear changes happening in the labour market. And so unemployment rose until the early 2000s or thereabouts. And then particularly from 2015 time, there was a clear fall in unemployment in Japan down to below 3% before the onset of COVID. And 3% unemployment, like 3% unemployment in Japan is perhaps not like 3% unemployment in another economy, but it does show that the labour market then was very tight. And so again, what you saw was this long process where, because of the particular institutional structure that Japan has, restructuring the economy takes quite a long time. But as with the banking sector, so with the labour market, there was this restructuring that happened over the course of 30 years or so, which meant by the time you got to sort of the COVID pandemic or just before that, you're in a situation where the labour market was quite tight and therefore wage growth would start to reappear. Now, that wage growth wasn't as strong as it might have been, partly because what happened after 2015 as the economy recovered and there was a clear upcycle in the economy at that time, was there was also a big increase in the female participation rate, which is something we've talked about on previous videos. What happened with participation rates in the labour markets across Asia is particularly important because of the demographic structures that these economies have. And so if the population is falling, it's very important that participation rises, other the labour market shrinks a lot. And if there's less people working, that's bad for the economy. Now, we explained and talked about that in a previous video. But the importance of that in Japan, particularly from the years until 2015 or thereabouts, is that process slowed down the fall in the overall unemployment rate and slowed down the increase in wages that therefore would have occurred. But still, this second point still applies. So one thing is the banking sector improved. The second thing is the labour market become much tighter over the course of time. So that's the second change to talk about. And I need to stop for Nick. So the third change is sort of the international side. And so, again, going back to the 1990s, what happened? Well, in a situation where Japan was a very expensive place to operate, and then the economy started to slow down very sharply. Now, what happened then? Well, a lot of companies realized they had to start to move production over shore, particularly as not just in the 1990s, but the early 2000s, there was this rise of China, right? And the rise of China as a manufacturing power was obviously a very significant development for somewhere like Japan, which until 1989 was this world-beating dominant manufacturer in many of the important technologies that the world was using at the time. And so what you saw, and again, we've talked about this in relation to other economies in Asia, is a big negative terms of trade shock. Because Japan was making these products which were expensive and therefore it had to cut prices to try to compete, particularly with China. A lot of companies from Japan did move production over to the mainland, which was essentially over to China, which is essentially a hollowing out of Japan's economy. At the same time, the rise of China was driving up global commodity prices. And so from the Asian perspective, and this is clear in Taiwan, Korea and Japan, there was a very big negative terms of trade shock across the course of like 20 years or so. And so this was another thing, which was another reason why Japan's economy was weakening a lot after 1990, is competition with China, the rise of the Chinese manufacturing sector, the shrinking of the manufacturing in Japan. One of the features of this was this very big negative terms of trade shock, which essentially reduces household incomes, and again was therefore another thing which weighed on the economy. But like these other factors, so what happened in the banking sector, what happened with the labour market, this thing also has begun to stabilise over the course of time. That negative terms of trade shock is now nowhere near as negative as it was 10 years ago or 15 years ago. And so that shock coming from China, obviously, we can see that still across different markets in the sense that China's getting very big market share gains everywhere. That shock as a particular hit to Japan is also one of the things that's lessened. And so what's the result of these three things to lead to the fourth conclusion, and the fourth thing which sets the stage for where we are today? It's really what's happened with inflation. And so this is obviously the big feature of Japan's economy for the course of the last 30 years or so has been deflation. Very unusual in the world economy where you have this picture where for a long period of time, prices don't just fall, but they continue to fall. And they continue to fall at quite a steady rate. Now, part of that is because of the labour market. So when the labour market was slackening off and companies had to try to hire more irregular workers because regular workers were more expensive. That was a period in which wages were falling in Japan. The way that companies could hold on to their full-time employees was to cut their wages in nominal terms. And that is something that fed into inflation. Now, again, like the banking sector, like the labour market, and like what happened with the terms of trade, we can see that the deflation impulse in Japan was lessening as you move particularly into the 2000s, and especially after 2010 or thereabouts. One clear way of showing that is this chart, which shows the services the producer price inflation in Japan, but for the services sector. So not looking at goods, but looking at services. And why is services particularly important in thinking about inflation? Because if we look at goods prices, and we'll talk about this a little bit more in the rest of the video, if you look at goods prices, that tends to reflect a lot of what's happening in the rest of the world. It's depending on global commodity prices, and it depends what happens with exchange rates. Services prices are much more driven by what's happening domestically. They're a much better reflection of domestically generated inflation pressure. Now, when you look at the services producer price inflation in Japan, you can see that that clearly bottomed out, particularly, but maybe even before the global financial crisis, but certainly thereafter. We've gone from a position where that was negative to now where that was very clearly positive, even before the COVID crisis hit. So I think there's a very good argument that in a very easy to make the case that before 2020, Japan's economy was already looking on much firmer ground. It wasn't nearly as weak as it had been historically. Some of the deflationary impulses were beginning to disappear. The labour market was tightening. The companies were in a better financial position, and so on. So this is all important context where we got to in 2020. And there's one further thing that we need to remember here, and that's policy. So the other thing that happened, particularly after 2013, is the Bank of Japan became much more aggressive in trying to tackle the deflationary pressures that Japan was suffering. Now, that was under Governor Kuroda and the prime ministership of Prime Minister Abe. In that period, the Bank of Japan really did two things which were particularly important. The first was to start to massively expand the monetary base, with the idea, this idea that if you double the monetary base, inflation will get to 2%. That was the initial policy. That didn't work in the sense inflation didn't get to 2%. The BOJ, though, had to continue to increase the monetary base because it was attached to this idea that inflation would go up. But then that led to the second policy initiative, which was this idea of yield curve control, and that interest rates will continue to remain very low in an attempt to get inflation to go higher. Now, at that time, interest rates in Japan were already very low. So it didn't actually reduce interest rates that much further. The importance of it, and why we need to raise it in terms of the background to understanding what's happening today, is that really leveraged Japan's monetary policy to conditions in the rest of the world. So just reducing nominal interest rates doesn't really change very much if interest rates are already 1%, right? You get a little bit more of loosening, but it's nothing too dramatic. What you really need to happen is either inflation needs to rise or something needs to happen overseas, that because you're keeping interest rates very low, overseas conditions can massively change the exchange rate. And obviously that's the situation we've been in since COVID. And so this unexpected rise in inflation that happened in the US and the rest of the world after 2022 resulted in a very big increase in interest rates in the rest of the world. Japan, because of the monetary policy that the BOJ was following, was committed to keeping interest rates very low. And you can see on any chart, right, like if you look at any kind of financial market observer who looks at what happens with the yen, one of the most important charts they look at is the correlation between the yen and nominal interest rate differential between the US and Japan. That tends to be a very good indicator of where the yen is going. And so what happened was, because Japan was keeping interest rates low, the Fed increased interest rates very aggressively. That nominal interest rate differential between the US and Japan widened massively, and the yen suddenly went up from something like 100 up to 160 over the course of 2 or 3 years, right? The weakest exchange rate that Japan has had in a long, long time. And so you had this context where the economy was already looking quite a lot better, and then you had this hit coming from monetary policy. And that sort of is the context of where we are today. and sort of like gives a good, I think, understanding of, is an important background for trying to understand now what happens with tariffs and the risks from tariffs. So if you look at that story, what we really say is that the economy was looking quite good. Now that was, all of the things I've talked about really are up to 2020 or thereabouts. After 2020, Japan, like the rest of the world, suffered a very big recession because of what happened with COVID. And that was something which it took a long time for Japan to get over. So the economy didn't really start to recover until about 2022 or 2023 time. Now, at that point, you had this situation where the Fed was already raising rates aggressively, and so the yen was weakening. And so what you saw happening in Japan, there was these foundations for the economy being better. And then you had this hit coming from monetary policy in the rest of the world, and suddenly Japan, for the first time in a generation, starts to see quite high levels of inflation, right? Like inflation of 3 or 4 or 5%, right? This is unprecedented in Japan, really, for a generation, for 30 or 40 years, that these rates of inflation haven't been seen before. Now, at that point, if you go back in 2022, 2023, it's sort of one of those things that it's the wrong type of inflation. Because again, as I talked about in reference to the services price inflation earlier, economists generally try to differentiate between two types of inflation. There's sort of imported, goods price inflation, imported inflation. It's nothing to do with prices being generated domestically. It's all because of prices that are happening overseas. And so particularly in 2022 and 2023, Japan saw this very big increase in goods prices generated overseas, which, because the yen was weakening, meant that in yen terms, these products suddenly became much more expensive. Now, why is that important? Because it's not becoming from domestically generated wages. It's not because consumption domestically is increasing. It's just because prices overseas are increasing and therefore pushing up yen prices domestically. Obviously, that means that consumers don't have any more money to buy those things. And so, as the obvious example, if the fuel price goes up a lot, and obviously Japan is very dependent on oil imports from the rest of the world for its energy needs, particularly since the earthquake and so on, and the big reduction in nuclear power processing in Japan. Since that time, Japan is very dependent on oil imports as a source of energy. What happens when the cost of petrol or gas goes up? Obviously, what that means is consumers have less money to spend on other things. And so this is one of the things that interrupted or slowed down the recovery in Japan's economy. On the one hand, the BOJ was getting exactly what it wanted. The monetary policy was working exactly the way it should do. Finally, because of this change in the rest of the world, very low interest rates in Japan forced up prices domestically. But that came with a cost, because it was all imported price inflation. And import price inflation is very bad for consumers if incomes aren't going up at the same time. And the Bank of Japan talks about this, right? So they started to talk about these two different types of inflation, but in the context of the increase in import prices is something that was much more likely just to be the first stage. And then there would be a second stage thereafter where inflation would start to transit into something which was much more domestically focused, much more generated by what was happening in Japan domestically. So that leads to kind of the where we are today, and to introduce kind of the issues that Japan now faces as we come into tariffs. Because if you go back to the beginning of this year, there were very clear signs that this transition of inflation away from goods prices towards a sort of domestically generated wage price spiral was exactly the thing that was starting to play out. And there are various ways we can look at that. So again, earlier I talked about this survey that the Bank of Japan does. The quarterly survey, there's a very large number of companies across Japan. It's a real benchmark survey. The Bank of Japan relies on this very strongly in terms of what it looks at for what's happening with the economy. Now, what does that survey show? What has that survey showed over the course of the last few months? How can we have some confidence that there has been this transition away from goods price inflation and imported price inflation towards something which is more domestically generated? And there's 2 or 3 things which really stand out. So the first is that this Tankan survey asks about the tightness of the labour market. It asks about how difficult it is for companies to hire workers. And these charts have really been, off the scales in terms of the tightness, right? Particularly in the services sector of the economy. These surveys show that the labour market is even tighter than it was in the bubble economy of the 1980s. And if you look at the economy broadly, so even including the manufacturing sector, across the economy, the labour market has been extremely tight. That's a very clear finding from this survey. Now, why does that matter? Because that feeds into the second thing that's very clearly been happening, which is increase in wages. Now, wages again, and again, related to the rest of the discussion we've had, wages, we can look at wages for regular workers, for full-time, those salaried man workers, lifetime employees, and we need to think about what's happening wages for part-time workers and the irregular workers. Now, for that full-time stuff, it's very much decided in Japan by a yearly process, which is this unionized process where unions discuss with their employers where they think wages should be. Now, for the last couple of years, and very consistent with that idea that the labour market is extremely tight, wage decisions in Japan have been very high. So for the last couple of years, wage growth has suddenly been above 5%. That's a bit misleading in the sense it included these seniority wage increases. So people who stay in the companies for a long time, their wages go up over time. But even excluding that, and just looking at the so-called base wage, that's also been increasing by about 3.5% year on year. So it's pretty good, right? Like that's not a very pedestrian level of wage growth, even relative to other developed economies. So again, the labour market looked like it's very tight. That was very clearly feeding into wage growth. The other thing that the survey shows has been going on is that pricing tensions from companies have remained very strong. So there was this feeling, again, if you think about that transition the Bank of Japan was talking about, away from this period where inflation was driven by imported prices in the exchange rate to where it was going to be driven by something happening more domestically, the idea in that process was inflation would slow down and then it would start to stabilize and pick up again. In reality, what's happening with Japan is that inflation hasn't really come down at all. And one of the reasons for that, or one of the sort of indicators that that would be the case, is the price tensions within the Tankan survey, which tends to lead inflation with about a 6-month lead, or, inflation lags that indicator by about 6 months or so. And that's been consistently showing that inflation is actually going to remain quite high. So that's the third thing we have. So we have what's happening with pricing tensions, what's happening with wages, and what's happening with the labour market. All of those things have been pointing very strongly to the idea that Japan should be making this transition away from import prices and exchange rate-led inflation towards something which is much more domestic. And then that leads to the final thing, the final part of the process, which is particularly important in where we actually think about tariffs today, is the whole reason this has been happening is because by far the strongest bit of the economy has been the non-manufacturing sector. It's been the services sector. Now, why is that important? Obviously, because tariffs focus on exports and manufacturing. And if you go back and think about Japan, during that period where the long period of deflation, and particularly think about the best cycle that Japan had in that process, in that whole period, which is cycle into like the global financial crisis in 2008, like the manufacturing sector then was on fire, right? Exports was super strong. The auto sector was doing very well. China was importing a ton of stuff. Like in that process, it was all led by manufacturing. And this was how Japan was often viewed, right? Like it was the only thing that mattered. The only thing you needed to think about in terms of the economy was what was happening with the manufacturing sector. Now, if you look at what's happening today, and this chart shows, again, the Tankan result, which looks at sentiment among manufacturing companies and among non-manufacturing companies. This very clearly shows that this time, in this sense, is different. That the reason the economy has been strong over the course of the last 2 to 3 years, the reason wage growth has been strong, the reason prices have been going up, and the reason the labour market is particularly tight, it's all because of what's happening in the non-manufacturing side of the economy. It's what's happening with services. And so this is important. It's important because it's changed the way that Japan's economy works. And obviously then it has implications for then tariffs. And so if you go back and think about if we were in the same world that we were in 2008, where the manufacturing sector is clearly in control, the export sector is booming, in that situation, tariffs would be a disaster for Japan's economy because there was nothing else going on. And so if exports was to slow down very dramatically, that would have a big impact. If you look at where we are today, it looks quite different. The non-manufacturing sector has been quite strong, has been leading the cycle. In addition, the manufacturing sector and exports have really been doing nothing. So despite the fact that the yen has been very weak over the course of the last 5 years or so, export volumes haven't really increased at all. industrial production has gone nowhere. Like, there hasn't been a big manufacturing impulse in the economy over the course of the last few years. The only reason we can talk about this transition away from sort of imported price inflation towards the consumer, where non-manufacturing, towards domestically generated inflation, it's all because of the non-manufacturing sector. And so when we think about tariffs, this is obviously important because tariffs don't directly affect what's happening in non-manufacturing and don't affect what's happening with services. Now, there's one more thing to kind of add into the mix before we think about some of the conclusions from this, and that is that tariffs haven't been the only shock that Japan has faced over the course of the last 6 months. The other thing that's happened is that there suddenly has been this big rise, once again, a sort of resurgence in goods price inflation. So inflation's gone up quite quickly again this year. It's all been because of goods prices. So services price inflation is firm, but it hasn't re-accelerated. The reason overall inflation has gone up is because good prices have really gone up. And the poster child for that is this massive increase in the rice price, right? Like, rice prices doubling over the course of the last year or so. Obviously, rice is a particularly important product in every Asian economy, and Japan is no exception to that. And so what does that mean? That is a big negative shock for the consumer sector, because if prices of goods go up, wages aren't going up by the same amount, that eats into consumer incomes. So the other thing to bear in mind today is that Japan has faced not one shock, but two shocks. One shock is what's happening with tariffs. The second shock is this big increase in import prices, and that can be in rice prices, and that can be seen very clearly in this big fall in consumer confidence that's happened over the course of the last 6 months. It started to happen well before Trump was elected, and certainly before Trump started to talk about tariffs. And so, again, think about where we are with the economy and where we were 6 months ago. You can make a very strong case that Japan was in this position where the BOJ would finally be able to raise interest rates above 0.5% because the economy was in quite a good position, transitioning away from goods price inflation towards services price inflation, where wages were rising, inflation was sustainably 2%, interest rates of 0.5% are really far too low. Where we are today is that Japan has suffered two shocks which have interfered in that process. One, which is at the front of the mind for the BOJ, is what's happening with tariffs. But there's a second shock, which is an increase in goods prices, which is eating into consumer confidence and has started to threaten that strongest bit of the economy, which is services and the non-manufacturing side, because incomes in Japan are being squeezed. So now, let's talk about some of the conclusions and some of the implications of this. And really, this is sort of thinking about scenarios, right, of what the economy might look like over the course of the next 6 months ago, because there's a lot of uncertainties, in particular in the way that tariffs occur. But one thing to be thinking about is it does look now likely that second shock, that the big increase in import prices eroding consumer incomes, that second shock has begun to lessen over the course of the last 2 to 3 months or so. So you might well have seen there's a new agriculture minister in Japan. There's been a much more aggressive attempt to try to reduce rice prices. And the sentiment surveys coming out over the course of the last 2 to 3 weeks have suggested that big shock in terms of consumer confidence is now beginning to lessen. And so in one sense, the economy is once again beginning to look like it's on a more stable footing. So that's one thing. The second thing, obviously, that's happening, though, is that the tariff stuff is getting much worse. So again, like, there was the initial threat on April the 2nd. The auto tariff stuff has never gone away. And now Trump has come in again and said that tariffs are coming of 25% on August the 1st. Now, because he said August the 1st, it does look like the idea is still to try to force concessions from Japan over the course of the next three weeks or so. And 25% tariffs on everything coming from Japan, is a big risk to the economy because the manufacturing sector is still important. So I'm arguing that it's not the thing that's led the cycle. That doesn't mean that it doesn't mean a big fall in exports would be damaging to the overall economy. And that's something that's clearly being reflected in BOJ forecast, where they have, on the initial threat of tariffs back in April, they did slash the forecast for Japan's economy. So this is an important issue. And so where does that leave us? If you think about sort of, what the US might want, right? Now, the US obviously, the US wants some concessions from Japan or something, right? Like, it sort of seems difficult to believe that Japan is going to become a bigger importer of US autos anytime soon. But presumably, Japan could move much more on the agricultural stuff. Like, it's not a huge, in terms of the numbers of people these days, it's not nearly as important constituency as it would have been like 30, 40 years ago. The urban constituency is much bigger and they're consumers of food, right? They're not makers of food. So presumably there's some concessions that can be made there. But the other thing I think to think about is, what does the US want with the exchange rate? And so there was some talk 2 or 3 months ago that for Japan, Korea, and Taiwan, that the exchange rate would be included in the tariff negotiations that Japan was having with the US, because all of these exchange rates are weak. Now, if you look at what's happened since then, the Taiwan dollar has really appreciated a lot. The yen hasn't gone anywhere. And if you think about the yen and what might propel the yen to go stronger and therefore lessen some of the upwards pressure on the dollar, the most likely thing is that the BOJ remains on this path where interest rates steadily go up. It's much more likely that the yen appreciates in a positive way if that's the case. And so, from a more thoughtful position, I think, you would argue the best thing that the US can do is to make sure that Japan stays on that path and therefore Japan isn't pushed into recession. If that was the case, and we could be sure that by August the 1st, that the BOJ can start to say that the risk of tariffs is lessening, the negative shock coming from the increase in rice prices is also lessening, I think we'd very be clearly on this path in Japan, where the BOJ is once again becoming positive on the outlook. The market is starting to price in price increases again in terms of interest rates from the BOJ, and the yen is strengthening below 140 on a path to somewhere around 125. If we don't have that, and we're in the situation where we get to August the 1st, tariffs are not just put up to 25%, but Trump is so annoyed with the Japanese for not getting any concessions that he continues to say the tariffs are going to go higher still. It's very easy to see Japan. It's possible that Japan is going to be pushed into recession because of that. The BOJ isn't going anywhere with rates. Now, what does that mean for the yen? There's 2 possible scenarios. One, if the Fed is remaining very bullish about the economy and partly because tariffs are pushing up inflation in the US, that means that the interest rate differential is going to widen once again, and the yen very easily could be back towards 160 or thereabouts. If, on the other hand, tariffs put the whole world recession whole global economy into recession, including the US, and the Fed is cutting interest rates aggressively, that's likely to mean the yen strengthens quite a lot. However, that's not going to be a positive situation with Japan's economy, because it's in a situation where the world economy is already very weak. So you have these, I think we can talk about these 3 scenarios. One, the yen gets to 110 on the back of a global recession. Second, the yen is at 125 because of this period where the BOJ is once again in the situation it can raise rates. Third, the yen stays at 140, maybe weakens back towards 160 because the Fed and the US economy is doing well, but the imposition of tariffs puts Japan into recession. Now, I've been favoring the middle course where the yen gets to 125. But at the moment, I don't think that isn't something that's likely over the course of the next 2 to 3 weeks, because we still have this risk of tariffs. If the tariff thing comes in on August the 1st and is very high, then I think it's much less likely that the BOJ is going to be able to raise rates. And in that situation, like the yen trade, which is the market has been waiting for pretty much all year, that yen trade of the yen strengthening, I think, will remain off the cards, for the foreseeable future. So I think tariffs are important. They're not the only thing to think about in the economy because of what's happening with the non-manufacturing sector. But to have a clear path for the BOJ continue to raise rates, I think you have to think that the tariff threat has to be moderated, and then it becomes a more constructive path for the Bank of Japan. So I talked about a few things today. Talked about what's happened in Japan in the run-up over the course of the last 30 years and why we can start to think about Japan in a different light to where we were previously. The second thing we talked about is what's happened over the course of the last few years, both the BOJ policy since sort of 2015 time, but in terms of the particular characteristics of the recovery that's happened with COVID. And the third thing then is to think about what's the implications of that for the yen and these three different paths that might follow. Like, I do a lot of this sort of analysis at East Asia Econ. We're also going to be focusing this tariff stuff and what that means for the yen very closely out over the course of the next 2 to 3 weeks, because I think it is very critical time which will determine where the yen goes in the next 6 months of the year. And if you'd like to follow this in more detail, please get in touch with me or look at our website, eastasiaecon.com, where there's a lot more analysis you'll be able to find there. Thanks very much for viewing.